the yearly accounting cycle, from the journal to the accounts, to the trial balance, to the adjustments, and finally to the income statement and the balance sheet. In this lesson, we shall also take a view at the big picture of the firm. We began to study the mechanics of double entry accounting. We are not finished, but let's step back a minute and have a glance at the big picture. That will help us understand what we are doing. Firms have a beginning date and then, in theory, they run forever. From a managerial point of view, their life will be split into accounting periods, usually years, and to simplify life, calendar years. The management monitors how the firm performs from one period to the next. It can be represented like this, the accounting cycles. There is the first year of the firm, then the year number 2, year number 3, etc. During the first year, we shall compute an income statement, and at the end of year number 1, we shall compute a balance sheet. The income statement will be a presentation of the sales, also called revenues, and the consumption of the year to produce these sales. And the balance sheet will be an organized presentation of what the firm owns and what the firm owes. Then, year number 2, there will be an income statement for year number 2 and a balance sheet at the end of year number 2. Same for year number 3, etc., etc. The computation for over one accounting cycle look like this. It's called the accounting cycle. We start from the journal, where we have entered each transaction chronologically. Then each transaction is posted into 2 accounts. We saw that. The collection of accounts form a book that is called the ledger, because it's a big book. Then, from the accounts at the end of an accounting period, we shall compute something that is called the trial balance. So I represented a funnel into which we put some information from the accounts, the balances to be precise, and we produce something called the trial balance, trial because it's not final. Then this trial balance will be adjusted with some more transactions which are less obvious than those recorded into the journal at first. So there will be adjustments, and this trial balance adjusted will produce the income statement, which, as I said, is a presentation of the sales and the charges or cost or consumption of the accounting period, and will also produce a balance sheet, which is a snapshot of the firm at the end of the accounting period. Each accounting period, double entry accounting will produce, as we saw, an income statement presenting sales, also called revenues, also called turnover, and the cost, also called consumptions, to produce these sales. The difference is the profit of the accounting period. And at the end of each accounting period, double entry accounting will also produce a balance sheet. That is, an organized presentation of what the firm owns, it's called the assets of the firm, and what the firm owes, it's called the liabilities of the assets. A word on accounting periods. An income statement can be computed over any period, T1 up to T2. And a balance sheet can be prepared at any date T. So we can say somehow that an income statement is a film or a movie of what's going on in the firm between 2 dates, and a balance sheet is a snapshot of the firm at any date. But it's convenient to do that every year. So one thing that is important is that there is no notion of an income statement at one date. An income statement is over a period of time. And if casually we talk about the income statement at such and such a date, usually we mean over the year ending at the date we talk about. And a balance sheet is something that can be prepared at any date. It can be prepared in the middle of August, it can be prepared at the end of September, whatever. Usually it's computed at the end of the accounting period, and when accounting periods are calendar years, it's computed at the end of December. In fact, it takes several weeks to prepare, so really for a given year, say 2009, the balance sheet will be really finished, the computation, sometime in February or March or April. That's why annual reports of big corporations with calendar years as accounting periods usually are published in April or May. Why years are more convenient accounting periods than other things? Well, because the operations of a firm can be meaningfully compared then from one year to the next, whereas comparing, say, quarters to quarters can be muddled by seasonality. There are some quarters for some activities, some quarters are weak and some quarters are full of activities, and comparing the two would not be meaningful. A word about the sharing of revenues. The revenues, that is the sales of a year, are split into 4 parts. A part goes to the suppliers, the cost of purchasing various staff, raw materials and other supplies from external agents. A part goes to the employees, the salaries and various charges that will be paid to the employees later, retirement payment, etc., insurance policies. A part goes to the state, taxes of various sorts, essentially 2 types, VAT and the tax on the profit. And finally, the difference between the sales and all this is what goes to the owners and is called the profit. By the way, this part is called the value added by the firm, whereas this is the external purchases. So let's finish with a brief word on the logic of owners and the logic of employees. The logic of owners is to maximize their part of the pie, that is the profit. Therefore, to reduce the other parts per unit produced via productivity improvements and via cost of work reduction. And another logic in the Western world is to make the firm grow, presumably because it makes it stronger and, of course, also will produce more profit. Whereas the logic of employees is different. It is to increase their salary per unit of time worked and to reduce, it's the same thing, in fact, their time of work without reducing their salaries. And this, of course, leads to conflicts, which are natural conflicts. Sources of conflicts. The first one is precisely the productivity improvements. When the managers working for the owners try to produce the same volume with more machines and less work, and usually that's less costly than to work with machines, well, that creates a conflict. In the history of industrial firms, since the Industrial Revolution, there were several social movements of workers trying to destroy machines. The first one is the Luddites in the United Kingdom in 1811, and another one is the revolt of the Canuts in France in 1831. Both were in the textile industry. And another source of conflict, which is even more recent, has to do with delocalization. The globalization of the world economy leads some Western firms to delocalize production to countries with lower wages. Well, this leads to unemployment in the West. The logic says that, well, the unemployed people have to do something else, but that's not quite as simple. This leads to social difficulties. Many people have difficulties doing other things than what their boss tells them to do.